Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, September 3rd, 2019. It's a little after 1 o'clock Eastern as I'm starting this video, and what I want to do is take a look at the major asset classes. We'll start out with the stock market, the index ETFs. I'll cover large caps and small caps. Then we'll look at the flight to safety assets, gold, treasury bonds, silver, the other precious metals. And I also want to get into, take a look at junk bonds. Haven't talked on the junk bonds in a while. There's some things that I'm seeing there that are worth noting. Treasuries as well, of course, that's part of the flight to safety assets I just mentioned. And then time permitting crude oil. So that's what we'll look at here. So we'll kind of hit on everything. All of those are interrelated. They are completely separate asset classes, some of which have an inverse correlation, meaning one goes up, the other goes down, such as stocks and bonds, and yet others are positively correlated, such as crude oil in the stock market. So we're going to get to those and see if we can glean any clues as to what's going on, or more importantly, what's going to happen going forward. Start out here real quickly. I mentioned this on the front page today. We had the ISM Manufacturing Index reported today at 10 o'clock. And we came in below expectations. You can see the consensus range right there. We came in at 49.1. Any reading of 50 or above is considered expansionary, meaning the economy is expanding, and anything below 50 is contractionary. So what happened at that point is we had the markets a smackdown. This is a 1 minute chart just to show you, if you haven't, if you weren't trading today, if you're catching up on this video later today or even now and you haven't seen what happened, we gapped down today and the markets were, this is SPY right here on a 1 minute time frame. So this is Thursday's or Friday's close right here. And then we gapped down and the markets were on their way to trying to backfill the gap. Backfilled about half of it, but all of a sudden ISM came out at 10 p.m. and boom, smacked the market down. Since then, it has been trading. It had a brief overshoot of some key support levels. I'm going to get to these charts in a second on the 60-minute charts of SPY and QQQ. Both SPY and QQQ had a brief momentum-fueled overshoot, but throughout the day they've been trading right above that level. It's give or take around 290 on SPY, and we'll get to the comparable level in QQQ. So that's what happened today. And keep in mind, guys, if you go to the site, if you click here on resources, it brings you in this link right here on the main menu, brings you to the right side of the chart. Support center, all kinds of good stuff in here, FAQs, account settings when you're logged in. If you're not logged in, you're not going to see the account settings there. Tools of the trade right down here. There's your economic calendar. If you click on that, it opens up the economic calendar, and then you can see right here, you click on ISM, the red dot are the most important market moving, potentially market moving reports. And so there it is. So that's where ISM came in today. And again, so what's going on now, as I said in the post earlier, are cross currents. Those that are bullish on the markets and the economy, taking the glass half view, saying, you know what, that's a good thing. Why? Because it's now solidified or increased the chances of not only are we going to get a rate cut at the next meeting, but instead of a quarter point, we now might get 50. The market's been teeter-tottering between whether we're going to get another quarter point or 50 basis points. And so this, if you look at a glass half empty, it's saying, look, the economy is slowing. And I don't know of any, there's been times, 2015, 2016, we had it look like things were rolling over, and then we picked back up. So it is possible sometimes you see things turning down. And by the way, this is not GDP. That's recessions are measured in expansions by GDP, which we just had a week ago. It's going to be another quarter before the next GDP rolls out, but remember, it's going to be well after the fact before the government confirms that we're in a recession via those metrics. The market will have already dropped probably 20-30% or more by the time the government makes it official. So you don't want to try to trade on that. It's like driving, looking in the rearview mirror if you're waiting for GDP 2 consecutive quarters of contraction because of the lag time in reporting and the after-the-fact revisions to GDP. It's almost always revised downward after the fact once the economy has turned. All right, so what I wanted to share with you other than that is this chart here. This is a federal funds rate. We're going back all the way into the 60s here. So modern history, we'll go back a few decades here. And what I wanted to share is this. The gray lines up on this chart, you can see the gray shaded areas right here. are the recessions throughout that period of time. So this was our last recession right here, the Great Recession they call it, 2007 to 2000, early 2009, and all the other ones before there. Some of them come, here was back-to-back recessions with a little reprieve in the middle, but they're usually spaced out, and right now we are at the longest economic expansion ever in history of the U.S. financial markets since they've been recording this stuff. So just know that another one's coming sooner or later. It's inevitable. Recessions are like the seasons. They're not as spaced out as predictably, but you need to have them. They're a natural part of the business cycle. They help purge out excesses, and there's a lot of other reasons that you need, and it's always has been and always will be part of the business cycle. And there's not anybody, an economist or anybody on Wall Street that will deny that we're not going to have another recession. The big question is now when. Is it down the road? Is it 2020? Is it 2021, 2022? So, well, let's just look at what happened in the past. So if you're wondering what's all the fuss about interest rates and the Fed and this hyper focus, well, throughout history, the Federal Reserve has raised interest rates during times of economic expansions. Remember, anything that's not shaded gray is an expansion. You don't see it here, but the economy is expanding. And what happens if it expands too fast? You get inflation. So when the economy starts heating up, the Fed will start raising rates, usually the midpoint of a business cycle up to the end of the business cycle. Then they see the ship is gradually turning. And the economy is like a super tanker. It doesn't turn on a dime like a speedboat. It makes a slow turn, and it's been slowly turning for a while now. We're not, like I said, we're not officially in a recession yet, but there are those that think it's inevitable now, and imminent, I should say, like myself, and then those that think, well, we can continue to postpone it with these easy money policies. Well, let's take a look at that. Okay, so you can see all the recessions, and again, you can see the pattern of rates rising up until just before a recession, and then the Fed coming in and starting an easy money policy. So let's look at what happened. Now, the reason they do this, the reason that they cut rates, well, first of all, you have the economy slowing, so inflation that's not a risk, it's usually deflationary. But more importantly, they lower rates then to spur economic growth. Because if a car loan is back here, let's say 10%, that's just the Fed fund rate. Keep in mind, you don't borrow at the Fed funds rate. Only banks borrow at the Fed funds rate, at the lowest rate possible. They mark up. So you're not getting a car loan back then at 10%. Your car loan was up here at 14 or 16 or something. But again, this is they indirectly control rates in the economy, especially on the shorter term, by raising and lowering the Fed funds rate. So here we go. We dropped from about a little north of 10% right there. It's supposed to snap when I put my cursor on there. You can see it's saying 9.75, but you're actually above 10. Let's just round off here. You went from 10 to about 3, right? So there's a 7% drop. That's a big impact. If you're going to buy a car and you were looking at, let's just stick with this number for now for practical purposes. Let me not add in the extra costs that a bank will charge. So now you were looking to buy a car or a house at 10% interest, and now you can borrow at 3. You're going to do that. Companies will then expand, buy a new plant, hire new employees, and again, you're a homeowner. Rates are low. You might take out a second mortgage, build a pool, or remodel your house or something, and so it spurs economic growth. So there it is, 7% drop. Right here, we were around 11%. Fed started to cut. They second guessed what was going on. As you can see there, during the recession, they realized they thought the recession wasn't there. They started raising, and for whatever reason, they got up to about 13, almost 14%. Then they realized, hey, we're in a recession. Aggressive rate cutting campaign. So here we go. We went from about 13 down before all said and done to about almost 4 down there. All right, so that's a 9% drop. Another recession here. Rates were really high right there, about 17%. That's when they peaked back in the late 70s. Well, that was mid 70s at that point. They cut it all the way down to about 8, almost, we'll call it 9%. So a big drop there, right? And you had an expansion in between. See the white there? Once again, here we go. We went from 20 down to, by the time shortly after the recession was over, down to about 8, a little better than that, 8.5. So we'll call that about a 10% cut, right? And so forth and so on. We're raised here. They started cutting early on this one. We're down from 10%. They took it all the way down to under 3, so we'll call that a 7% drop. So my point is, this boosts the economy. This is what I and a lot of others are saying. The Fed has used up all the arrows in their quiver. See all the downside to go? They had plenty of room to cut 7%, 10%, 5, 6, 7%. 2000, when the dot-com bubble burst, we had a stock market bubble back then, but they had plenty of room. They were at over 6.5%. They took rates all the way down to about 1%. And this is where things started getting easy. They tried to take it back, and they did that. And then they created the Great Recession. They took rates up to 5%, but guess what, guys? They still had 5.25, a little better, almost 6%, about 5.5, we'll call it. They took it down to near zero at after the financial crisis back in 2007 to 2009, right? They tried to get out of this hole, just like Japan did, decades ago, a couple decades back, but they only took it to 2.3. So here's my point. Where do they go from here? All you can drop, yes, I know Europe has negative rates, but that's effective. Very few banks over there are actually deducting money from people's checking accounts. Most people are just getting zero on there. People will pull their money out of the bank and stick it under the mattress or in gold and silver, which they are doing, by the way, and we're going to get to that. The theme of this video will be red flags. I'm seeing red flags everywhere. However, my point being that the Fed, although negative rates are technically possible, and maybe we'll see that at some point, where are you going to go? Negative 0.10, negative 0.20, you have no downside. The most they can do right now, effectively, is cut rates about 2.5%. Every other time they did 5 to 10%. Of course, rates are higher. You go from 20 to 10, that's a 50% drop. And you get down to these lower levels, it's smaller. But again, so my point is, this isn't going to have much of an impact. On top of that, we're coming off, if you look at this, here's the other thing, and it just, I'll tell you, it scares the hell out of me going forward. Every other time we had a brief period of low interest rates and then rates move back up. So what's happened is, they're not only are they pushing on a string, but we've had now a decade of near zero interest rates, minus this little blip up here. What business and what homeowner that's been around since this point hasn't already financed? What good is it going to do at this point? In other words, yes, there's an added benefit. There's always new people coming into the market to buy a house or to buy a car, but the impact is much less at this point in time, because we're coming off a period of extended low interest rates. You're not going to get the huge boost that you got back here and here when you dropped from these high rates, and again, you were coming off a period of much higher rates, and you weren't at these extreme lows for very long. So that's long-term stuff, guys. And again, it plays into right now. So I think there are those that believe that this rate cutting is bullish for the market. I believe it's now pushing on a string, point of diminishing returns is that would be the one phrase I have. So one phrase I would use. Let's see, that's not what I want to show you. I want to show you this right here. This is a theme of this video. I see more red flags waving right now in this market than the Beijing Olympics or wherever this picture came from. And that's the other thing too, guys. On that, I'm seeing article after article lately coming out, and people are penning these articles as to why it's different this time. Famous last words in trading and investing. It's different this time around. Beware of that phrase. The bond market historically is always right. The bond market will usually give you indications that that there's problems in the stock market, and I'm seeing numerous articles and beliefs that they're dismissing these yield curve inversions, everything that have had phenomenal, 100% track records going back for last 7 recessions, and now you've got those. This time around it's different. All right, maybe so, maybe not, but 10 plus years into an economic expansion, dangerous stuff. All right, so those are my thoughts. Now we look at the charts, and then I'll point out some of those red flags, other than the ones that I've mentioned in recent weeks: market breadth, deterioration, sentiment, things like that. But here's the charts. Let's just focus on where we're at now. I won't spend much time because I updated this chart this morning. We have the downtrend line. SPY broke out, and is backtesting right now, and it's backtesting dual support. So I think we're at a very important technical juncture. That's why I'm doing the video. We have a level I've been focused on for weeks now. That's about 289.90 right there. I have the line at 289.89. Lots of reactions along the way, and it's also the midpoint. If I take away all the lines, it's about in the midpoint of the trading range. Remember, I showed you in recent weeks that we have, a lot of times when you have a price channel or a trading range, you can put a line right about in the middle, and you'll notice that usually when the security breaks under that level, it tends to trade there. It acts as resistance. Boom, boom, boom. Then when you get above it, you tend to trade there. The midpoint is support. You break that support again, you go to the bottom of the range. You break above it, you go to the top of the range. Pretty simple stuff. Wash, rinse, repeat. So we're at the top of that range, coming up on the midpoint there. Again, I had the line at 289. You can call it all the way down to 288 if you want, and that's where we're at. So very, very important level, because if we break it again, I would suspect that that opens the door for a move back down to the bottom. And based how long we've been trading in this sideways range, as you know, my thoughts are if we even get close to the bottom, we're just going to keep going and go right on down through. So, if you're bullish and long, like I like to say, support is support until unless broken. So 289.90, it's been working so far. So we're intersecting support levels right now, and the fact you have not one support level, the downtrend line, but two, also price resistance, to me makes it even more significant, more important if we break it, because those eyes that are focused on the trend line, those traders that is, they will see that as a false breakout, a failed breakout, and those traders that are focused more, and maybe they see the horizontal price support, they might short a break of 289.90, or they might have longs with stops set below there. So therefore, that's a big level I'm watching. Here's a trend line off the lows on the trading range, so you don't have to take, obviously in technical analysis, if and as each reaction low is broken, each of those are potential support levels. But again, I already gave you my thoughts. I don't think they'll fight much. And then finally, I think a nail in the coffin will be a break below that line. And of course, you have the lows of the trading range not much further. So that's SPY. There's QQQ, or here's QQQ. 185.95, so we'll call it about 186, and that's the level I'm watching there. SPY has more of this wedge type shape pattern here, triangle shape pattern if you look at it like this, but you can draw a slight downtrend line. Let's just put it flat right there, and again, that's roughly the midpoint of the range right here, and you can see a lot of gaps defining. That's the thing about that range too. It's also defined by a lot of gaps. There's a let me see if I can grab this box tool. There's a gap. There's a gap. Another gap right there. And so a lot of gaps around that area. And again, very important support. So I think it's a battleground between the bulls and bears. This is the most significant battleground right here, the recent highs on both QQQ and SPY. And then again, I think a lot of people will be looking at the lows of the trading range, but I'm seeing these trend lines on SPY and QQQ that will probably do the trick and just blow right on through there if we can break them. And I do think they do break. It's my guess. But again, support is support until unless broken. Somebody asked me today, Randy, what would you do? Would you short here? And I said, look, if I was in all cash right now, I would wait till those levels go. TA 101 says don't short on a pullback to support. You either go long there if you expect a bounce with a stop below, or you wait until the support level goes, then you short. Let's not forget the daily charts too. I get tied up in the 60-minute charts, and I think that's a place to be when you're in a trading range, as we were throughout the entire month of August. And here we are. We're now in September. We're still in that trading range. But there's your trend line off the lows. So again, there it is. So you can see if QQQ breaks much below today's lows, because we're right on the trend line, we're going to break not only that support on the 60-minute chart, but we're also going to break this uptrend line on the daily chart here, and that's the December lows right there. So very key technical levels. And again, bigger picture, here's that trading range, I'll call it the August, soon to be August through September trading range right there, and that's what we're looking at. On that, before I move away from this chart, guys, don't forget seasonality here. Here's a weekly chart of QQQ, but let me turn off all the lines and just show you something. We are now in September. Most of the big drops historically, September through December is historically a very volatile period. We didn't have much happen. Well, actually back here, yeah, we can see this. There it is. Here's the year break lines right here. So you had that volatility last fall here, the fall of 2017. 2016, no dice. We were just coming off. We had just broken out of this trading range, and that started that strong leg up. But again, you can see usually when you go into the fall there, that's some of the biggest drops. Again, we're in that period now from September through November, sometimes December, where the big drops in the market come. So if I haven't made it clear, I'm expecting a big drop, probably bigger than most people are expecting right now. I still have long-term targets. I should say initial bear market targets that take us down to about those the highs back from 2015, 2016, and to try to measure it out for you again. That's from where we're at now, about a 40% or so drop. And the point is, that can happen very fast. It can happen much faster than most expect. Again, there's a lot of red flags in the market, so I'm going to go over some of those now. Let's start out with, well, I covered the markets. I promised you IWM, so let's do that real quick. IWM, small caps. Yeah, this chart's very busy, but the point is you have a downtrend line. Small caps top back in 2018. And have been in this, at least moving below this downtrend line there since. And so you have this downtrend right here forming. And on the 60-minute chart, what happened recently is we had small caps. We put in the divergent low, pointed that out, and there was even a trade to be made there, off the divergent low, rallied up, hit the first, second target. Last week I told you I didn't expect my third target to get hit anymore, even though I had a T3 zone from a couple weeks ago. I told you I didn't favor that being hit, and I got out of my small caps. And so what's happened since then is you can see we now have a fake out. Fake out being a failed breakout. We had a nice downtrend line right there, gave us this wedge type pattern here. We broke out, back tested, and then boom, failed. We're back down below. Today we backfilled the gap right there, and we're moving down below that now. There was a big gap from last week. So look, there'll still be divergence, so there's still a chance that we come on down and extend those divergences, but as of now, not very good. And more importantly, guys, the large caps. If the large caps break those supports, head down, they're going to drag the small caps down with them. So okay, as I've been mentioning recently, one of the big red flags to me, as I've said, is the tremendous bid, especially despite potentially bearish technicals. I say potentially, we have these divergences have been building, sharp negative divergences. Maybe they'll play out. They're not going to play out for a very big drop as if the stock market drops. I've made that clear today, both in the trading room, the front page, via questions. You can hedge up right now being short, I think, treasuries in gold and silver. I think the upside from here is relatively limited. I say relative, to the move. I don't think it's going to, we're not going to see another, 10% surge in treasuries. So I think the upside is limited. And, if the market holds these support levels that I just showed you and rallies, and I don't think it will, then you can see a big down in these. These a lot of hot air to come out. And that would be, let's just say, an agreement on the trade wars, a true agreement, not just something in rhetoric, which is that's what I suspect will come sooner or later, is some kind of positive spin, but with no bite to it. But that sets the stage for a correction there. But again, let's take it for what it is. These treasuries have been moving up despite clearly bearish technical postures. Extreme overbought conditions on the daily chart and these 60-minute charts, negative divergences. I've talked about this recently. We come down, both these divergent highs played out for a correction, but a very small correction. This one was more in time than price. We broke this trend line. We hit the minimum support level, the first support that I had on here, you can see, and we bounced so far. Again, so you can see the momentum has stalled out a little, somewhat. So I don't think that I don't think there's a risk of a melt up. Anything's possible. I'm still sticking with those for now, but I'm more concerned. Again, I'm just hedging up until I see which way the market goes. Then I may remove these hedges if the indexes break those support levels I just talked about. And we start to see that next impulsive wave down. Then I won't want to have. I don't need any hedges or won't want any hedges at that point. But I wanted to point out that this is a red flag here. That this is a very, very strong bid. This is the market telling you that smart money, individual investors, just about everybody is flocking to. They can't get enough treasuries. They're telling you they think the economy is headed down into a recession. This is with yield curve inversions, this rush into treasuries. The institutions are trying to balance out their risk models. They see bad things coming. That's my interpretation. There's no other reason for such a rush into bonds. This has been a tremendous rally. So that is a red flag. Why? Because this run up in treasuries with the stock market, yes, it's corrected, but look, it's right off all-time highs. That's my point. So we're really not far off all-time highs. And I just showed you, I see another, let me go to QQQ. What did I say, about 30% or so downside? And off the highs, all-time highs, right now, where we're at, we're 5%. So this, to me, somebody's wrong and somebody's right. Either all these people and institutions buying into treasuries, and it's not just treasuries. The other king of flight to safety assets, gold, same thing is happening there. So to me, this is a red flag. Now the bearish technicals are in place, but we keep moving up. In other words, they're not playing out yet. Again, these are some of the red flags that I'm watching. And also, let's look at junk. Now, junk bonds have held up. Junk bonds are the lowest rated bonds, which tend to usually trade in line with equities. Well, they topped out. The junk bond market, this is JNK, one of the ETFs. They topped out back here in 2014. And this has just been a red flag the market's been ignoring. They did rally off the lows in December just with the stock market, but lately, and today especially, we're seeing a pretty big down day. That's a big drop. Remember, bonds don't move as much as stocks. You're going to say, oh, Randy, it's only down 0.8%, but that's a big drop right there. And we also took out this trend line. So we're starting to see, this means credit spreads are rising. The risk of default. And junk bonds are called junk bonds. They're still paying interest. People buy them. They're just low rated, the lowest below investment grade. And during a recession, default rates will begin to spike. And then when that happens, these junk bonds the funds will lose value. And so there's another red flag right there. I should take a look at the corporate market. That's a whole nother, a lot of people think this is probably the biggest bubble right now in the financial markets. They think even more so than the stock market, I've heard. And I can, won't go off on all the reasons, but there's a breakdown right here in LQD, which is the corporate investment grade corporate bond ETF. So these are corporate bonds just like junk bonds, but these are investment grade. And the problem with it, just to tell you in 5 seconds if you haven't heard about it, is that the vast majority, a very, very large amount of the investment grade corporate bond issuance in recent years has been at the lowest end of the investment grade spectrum. And so what happens if there is, or when, not if there is, when there is an economic downturn, when there's a recession, a lot of those bonds will be priced down to junk. And then think there's just not that many buyers in the junk bond market. There's going to be a lot of these bonds being moved out of here. Many institutions such as pension funds, pension plans, other mutual funds, they cannot hold junk bonds, or they can only hold a certain amount. So therefore, there's going to be a rush for the exits as a lot of these bonds are downgraded out of investment grade quality into junk status, and there's bad things can come there. And remember, the bond market is bigger than the stock market. So we've had this huge run up because everyone was buying bonds and they're investment grade, but this is one area that could cause some problems for the financial markets. So that's that. Let's look at crude oil. This is USO, the crude ETN, one of the more liquid and popularly traded ETNs. And I've mentioned a couple weeks back that it's setting up. We have a nice downtrend line here to watch. And we also had a divergent low at the recent lows, and that divergence did play out for a rally. And we've hit this downtrend line several times since. I started pointing it out somewhere here. and we continue to hit, and now we've been rejected off that downtrend line. So I laid out in some of my recent scenarios, probably get another thrust down. The wedge may continue to form. See, I can extend these divergence lines like this. So if we do take another drop, we could even undercut the lows. That may set up the stage for a rally, maybe, maybe not. Remember, bullish chart pattern, this is a potential bullish pattern. It hasn't triggered a buy signal. Just like a rising wedge, prices are still in an uptrend. It's a bearish rising wedge until you get a sell signal. That was your sell signal there. There was a sell signal right here. So we don't have a buy signal yet on crude. In fact, a rally into resistance is a shorting op. And every time you can do, when you're in a downtrend, you either short, push, or bounces back to the trend line, or you wait to position long on a breakout. PPO trend indicator is below the 0 line, and where this goes will depend largely on the stock market. Again, I'm doing the video because we are at an important technical level. If the markets can hold and rally off these levels this week, then I would expect crude to move up. I would expect gold and silver to fall. They've really gotten ahead of themselves. I'll show you the futures real quick for you GC traders. Here's my 60-minute chart of GC. You can see, again, the momentum is waning. We had a strong run up. We had a period of consolidation. We broke above it. We're in this next period of consolidation. We consolidated there for a while. Then we thrust up. Maybe we have another thrust up out of there. But as of now, you have to be careful because we had these divergences in place recently. If any marginal new high at this point, you can see I can put out here. I'll clear that out for you. Any marginal new high, if gold has another thrust up, will still be a divergent high. And remember, divergence is not a sell signal, but it's an indication that the trend reversal, or at least in this case, we had a sideways consolidation after that divergent high right here. So I think the risk reward, let me make it very clear, is not very favorable. If you're not already long gold, I'm still a big proponent of gold as a core holding in your long-term accounts, or my long-term accounts at least. But as far as adding to it here, if you missed this run so far, do you want to chase and buy it here? No. At most, maybe scale in a small amount, and then if you get pullbacks it may continue to go up, burn through all these divergences. But again, I think the upside at this point in the near term is limited. In fact, I wanted to show you, I want to go to my long-term charts, and then we'll wrap it up. Okay, that's gold daily. We already covered that. Weekly. Okay, this is a chart that's many times in the past. Here's our bull market, or bear market, I should say, downtrend line, big symmetrical triangle pattern. There was your divergent low. This was the end right here till late 2015 is when the bear market in gold ended. And from there, we started a new bull market. Kind of went sideways in a big range for a while, broke out recently, and I said that would be a big breakout before it happened, and when it happened, 130. Ran up here. I have this was always my long-term swing target. A few months back, I added this one as an intermediate target, about 143.87. It's not as well defined, but there's a couple reactions there on GLD. So this is either a momentum-fueled overshoot, or we may go up here. But here's how I wanted to spin it for you. I look at everything from a risk-reward perspective. That to me is a very solid target. That's a target I've had here for over a year, maybe even 2 years on gold, and we're getting close. Here's the thing: we're only about 4% away from that level now. So I see about another 4% upside in gold until a decent consolidation or correction. And so therefore, the risk reward isn't very attractive, because it could also, should the market rally or something, it could drop real quickly down here about another 7%. So 4% upside to risk a 7% drop, not very favorable. But that's that. Silver, similar story. I have this uppermost near-term target. Again, this is a bull market. We just broke out. Silver was a little bit different, whereas it bottomed back here in late 2015 with gold, but then it put in another equal low right here, double bottom in a divergent low. Then the big buy signal was a few months back and pointed out before, and then right after we took out this downtrend line. That was the big buy signal. Now silver's run up and it's overshot my 1758 target by a little bit. That may prove to be a momentum fueled overshoot. If not, I don't have a lot. This is a long-term target zone. I don't think we're going to get there right away, but I don't have a lot of resistance until this reaction high here. So again, the risk reward, it's pretty overbought, very overbought when you look at it here. But again, we're in a bull market, guys. So as I always say, overbought in a bull market can and often does become more overbought or stay overbought for an extended period of time. So if you look at it back here in the last bull market, if you would have shorted overbought just because we're overbought, you would have missed all of this, because we stayed overbought and then became extremely overbought, and then finally those overbought conditions, there was a lot. You can see a little doji there, and that started the new bear market. Okay, I'll wrap it up here. I'll just loop back to QQQ because we've taken out now 185.95, so that opens the door. Next support would be this trend line. You can see a couple other levels here. SPY at the same time, right on that. We're at 289.80, and I have the line at 289.89 plus the downtrend line, so just a little more downside, and then that should get things going. Or we defend this level here, but with QQQ broken, I'd say a good chance SPY is gonna break that level and move down this week. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.